Okay. Good afternoon. Today I want to do a question. All right, so I want to believe we are able to see the question. So today we are going to do a question on the taxation of unincorporated businesses. So taxation of unincorporated businesses. So this is a practice question. For those that are students, this is your typical exam question. This one is even more friendly. For those that are doing Zika, expect to find a question with a scenario of about 2 pages, okay? With the requirements into the 3rd page. So those are the typical exam questions that you actually find. So I just thought I give you this this practice question, and then let's get chatting. For those that want tutorial services, I'm at your service, and I'm going to make it easy for you. All right, so let's dive into the question. So the first thing that you do when you are faced with a question like this one is go straight to the requirements. What is it that you're required to do in a question? Don't start by reading the question first. Remember, you've got 3 hours to do your exam in, and as such, you must apportion your time very well. So for those that are doing Zika, you've got question 1 having 40 marks. All right. So advisably, you must spend on average 45 minutes on that first question, and then split the 15 minutes that you're remaining with on the other section to do the exam. So don't waste much of your time reading the question without understanding what you're required to do in the question. So let's go to the requirements and then see what the examiner wants us to do. All right, so required: compute Jaden Mapalo Kapotwe's income tax adjusted business profits for the year ended 31st December 2023, giving reasons for any adjustments made. All right, so the examiner wants us to compute the adjusted business profit for Mr. Kapotwe. And then after we've made those adjustments, the examiner wants us to give reasons for the adjustments that we've made. So the reasons that you're going to give are the reasons that the Income Tax Act gives you with regard to those adjustments. So let's start reading the question now. All right. So Jaden Mapalo Kapot has been in business running a hardware store in Kawe for many years. His business premises consists of a shop with living accommodation above, which houses him and his family. For the year ended 31st December 2023, his income statement shows the following transactions. All right. So this is your typical income statement. Yes, you are used to seeing those straight income statements as one page. So we have split this as a T account, and we have the credit side and we have the debit side. The credit side giving us the profits, and then we have the debit side where we have the credit side giving us the income, then you've got the debit side where you have your expenses. All right, so we are talking about the same things. So the right side gives us the top part of your income statement, and the left side gives us the bottom part of your income statement, which you are used to. All right, so these are the transactions that we have. So we've got staff wages amounting to 74,160 kwacha. We have wife's wages amounting to 6,240. We've got rent and rates amounting to 6,300. We've got light and heat amounting to 21,720. We've got motor car expenses amounting to 3,360. We have telephone expenses amounting to 780 kwacha. Then you've got posted stationery and wrapping expense amounting to 10,800 kwacha. Then you've got repair and renewals amounting to 4,760. Then you've got bad debts written off amounting to 1,000 kwacha. And then you have miscellaneous expenses amounting to 3,460. Then we have advertising costs amounting to 10,240. Then we have loan interest. So this is a loan interest paid, which is amounting to 11,300. Then we've got depreciation on plant, amounting to 4,800. And then we have depreciation on motor vehicle, which is amounting to 1,200. The net profit recorded for this particular year is 156,400. So this profit is what we are calling the accounting profit. Okay, so this is the accounting profit determined or arrived at by the accountant for Mr. Jaden Mapalo Kapotwe. All right. Then on the credit side, we have gross profit amounting to 303,260 kwacha, and then we have profit on the sale of plant, okay, amounting to 2,400, and then we have a profit on the sale of a investment amounting to 10,320, and lastly, we've got bank interest received. All right, so bank interest received amounting to 540 kwacha. So the total income is 316,520. All right, and on the other side we've got 316,520. So that gives us a balanced balance there. All right, so now we have looked at those amounts, but the examiner tells us so the following information is relevant. Okay, so before we even dive into answering this question, we are told the following information is relevant to this question. All right, so let's see what they're telling us here. So note number one is saying Zambia Revenue Authority has agreed that 1/3 of expenditure on rent, rates, heating, and lighting is applicable to the living accommodation. So Jaden conducts business at a place where he also stays. So the shop is at the bottom, and then on top of the shop is where his house is. That's where he stays with his wife and children. So the expenses relating to rent, rates, heating, and lighting is applicable to the living accommodation. So it has been agreed that just 1/3 of it is applicable to living accommodation. All right. So now, what I'm going to do is I'm going to be explaining these things before we even start answering the question. So when you look at expenditures to do with rent, rate, heating, and lighting, so the income tax requires us to allow expenses that are revenue in nature and are only and exclusively incurred for the purpose of trade or for the purpose of business. So when an expense is revenue in nature and it is wholly and exclusively incurred for the purpose of doing business, then that expenditure is considered to be an expense. As such, you must not make an adjustment to that expenditure. All right. So the terms that we use for such is that we are going to allow that an expenditure. So if an expenditure is capital in nature and it is not only and exclusively incurred for the purpose of business, then that expenditure is going to be disallowed. So when we disallow an expense, we are going to add it back to the net profit when arriving at the business adjusted taxable profits. So I thought I should explain that so that when I use some of these terms, you don't get confused. All right. So the taxman has agreed with us, okay? The taxman has agreed with us to say the only 1/3 of these expenses are applicable to living accommodation. So what are we going to do to them? We are going to apportion the amounts relating to these things, rent, rate, heating, and lighting. We are going to apportion 1/3 of these expenses do not relate to business, they relate to accommodation as such. We are going to add them back, or we are going to disallow them. Number two, 1/7 of motor car related 1/7 of motor car relates to Jaden's private use. So 1/3 of the expenses to do with motor vehicle expenses relate to private use, not business related. As such, 1/7 is going to be disallowed when computing at adjusted business profits. Let's move on. Repair and renewal comprise of painting shop internally, plant repair, and then constructing extension to stock room. When it comes to repairs, again, the income tax has given us guidance. Okay, so the guidance that has been given is okay. So the repairs should be revenue in nature as well. So if it is revenue in nature and wholly and exclusively incurred for the purpose of business, we are going to allow it. Okay, so repairs are allowable expenses provided they are business related. If an expense is capital in nature, it is not allowed for deduction in the accounts. All right, and we must be very careful when we are dealing with repair and renewal. So repair is restoration by renewal. So a repair is restoration by renewal. So you're basically replacing a part or a subsidiary of a whole. Okay, so when you're replacing a part or a subsidiary of a whole, then you're doing some repairs. All right. But when you are changing the entire component, all right, so you're changing a big component of a particular asset. For example, if you are changing the engine of the vehicle, okay, when you change the engine of the vehicle, the engine is not a repair. Okay, so the engine is a very big component. Actually, the engine is the car itself. So when you buy engine, that engine is an asset. So it's a capital expenditure. So an expenditure spent on that engine cannot be disallowed. All right. So you must be very, very careful in dealing with some of these things, especially when it comes to renewal. So a renewal, you're replacing a substantial component of that particular asset. Or for example, you're adding value. Adding value is not replacing a window on a building. Adding value is when you extend a building, for example, so that you can have bigger space to increase your efficiency, create that benefit. So when you're adding value, that may be considered as a capital expenditure and as such must be disallowed. So from repair and renewal, we are going to allow paint shop internally. So painting shop internally is a revenue expenditure and it's just there to add beauty to the shop. So it's a business expense and they are painting the shop and not their house. Plant repair. So this is a repair that was done to the plant or which is an asset. We are going to allow it. Okay, so we are not going to do anything about it. Constructing extension to stockroom. So this is a construction work that was done to the stockroom. So they are making an extension. That is a capital expenditure and as such, it is not deductible, meaning we are going to disallow it. When we disallow, we are going to add it back to the accounting profits. Then let's go and look onto the bad debts. So what does the income tax tell us about bad debts? All right. So income tax tells us that general debts written off are not allowable for tax purposes because they are general and they do not specify a specific debt that may fall bad. So when you've got general reserves or you've got general bad debts written off, you are going to disallow that. So if there's an increase, yes. And then the other thing is if there's an increase in your general reserves, if there's an increase in your general bad debts written off, then you are going to add back that increase to your accounting. Profits are going to disallow that. But for specific bad debts that are written off, the income tax guides us to say those are allowable expenses, okay? But when specific bad debts are written off and later on you recover them, when they are recovered, they become taxable income, and as such, you must add back the recovered portion to the accounting profits for the purpose of calculating income tax. So that is another guidance. But if a business is that of giving loans, like for example, commercial banks, the commercial banks are in a business of giving loans. So when a debt is written off, it's a bad debt. When it's written off and it's specific, that bad debt is not allowed. It's an allowable expense, and as such, you don't do any adjustment. Any bad debt recovered must be taxable. So I thought I should actually echo that. So that's what the income tax says about bad debts. All right. So when you look at the bad debt account there, we've got two sides of the bad debt account, and I'm sure you must know how to read these accounts. All right. So we've got the credit side, and then we've got the debit side. All right. So debt, there's balance brought down. So the balance brought down. So at the beginning of the year, we have been told that there's an increase in general reserves. If you look at the bad debt written off, then this side there's bad debt carried down. Bad debt carried down, meaning so from the previous year we carried down some debt which was brought forward in the coming year. So we have general reserve, there's an increase of 2,000 there. So since it's a general reserve and there's an increase, we are going to add it back, we're going to disallow it. I think that's the only thing that we can get from the bad debt account. The rest of the things are allowable for tax purposes. Then let's look at the miscellaneous expenses. All right. So donations to a local charity. Donations to a local charity. So a local charity is a charitable organization. For example, the income tax has given us guidance on public benefit organization. So a charity is a public benefit organization, okay? And the guidance is that if it is a public benefit organization, it is approved by the Ministry of Finance and it is incorporated according to the laws of Zambia, then that any expense, any donation made to such an expense is an allowable expense on the part of the donor, all right? So that 100 kwacha, we're not going to do anything to that 100 kwacha. We're not going to add it. We are going to allow it. Okay. Subscription to Kabwe Chamber of Commerce. The guidance is that when you subscribe to an institution, an association, if that subscription is business related and then that expense is allowed for tax purposes, you don't make any adjustments to it. If, for example, you are an accounting firm that is registered with Zika and you pay subscription to Zika, that subscription you pay to Zika relates to your business. So you are not supposed to actually tax. It's not a taxable expense. So you must allow it, okay? In an event that you make subscription contribution for your employees that work in your accounts department to Zika, that subscription is also a revenue expense and relates to business and as such must not be taxed. It is an allowable expense. So 180, we don't make any adjustments. Entertaining customers. The law is clear. The income tax guides us to say entertaining third parties is not an allowable expense. As such, we must disallow it, okay? So if we entertain customers, that is not an allowable expense. Entertaining a member of staff is an allowable expense. So if you entertain your staff if entertainment is on your employees, then that is a business expense and it's revenue in nature, and we are going to allow it, and it's not a taxable expense. So as such, we allow such. But for entertaining third parties, customers and suppliers, we don't allow that. Obviously, the reasons are obvious. Why are you entertaining customers? Okay, so customers must come and follow you based on the value that you're providing, okay, on your value proposition. You should not entice customers to come and buy from you, okay? So such entertainment of customers are actually, businesses do that, but those are expenses that are not business related. And as such, they are disallowed. Christmas gifts to customers. Christmas gifts or gifts in general, gifts and entertainment in general, gifts are allowed only when they bear a prominent marketing or a prominent advertising feature for the donor. All right. So I would have given you an example of a gift. So, for example, Virtuous Tax Corporate Services prints or buys pens and they put their brand name on the ball pens. So that brand name of the company is a prominent advertising feature. So when I give that, if it bears a prominent advertising feature, then it is allowed for tax purposes, and I'm not going to make any adjustments. The other rule, the other requirement is that it should not exceed 100 kwacha to an individual, a customer or whoever person you are going to give that gift. So the cost should be within 100 kwacha per item, all right, per customer. So that is the requirement. Now, so should we say this Christmas gift to customer bottle of gin and whiskey, each costing 50 kwacha, then qualifies as an allowable expense? The answer is no, it does not qualify as such. We are going to add back that 700. You're going to disallow. The reason is gin and whiskey does not bear a prominent advertising feature for Mr. Jaden Mapalo Kapot. As such, we are going to disallow it. Payment to employee in lieu of notice, that is an emolument, and as such, it's a business expense, so we don't waste time on that. We are going to allow it. Legal expenses on debt collecting. The normal legal expenses are allowable expenses for tax purposes according to the Income Tax Act. As such, that is not going to be disallowed. We are going to allow it. Then we are told to say under the miscellaneous expenses, we've got sundry allowable expenses. So these ones we are told they are actually allowable expenses. So we don't even need to explain anything there. The own guidance is the charity to which the donation was made is an approved one. So if it's an approved one, then we allow for tax purposes. If it is not approved and it is not registered according to the laws of Zambia, then we must disallow. All right. All right, great stuff. All right, so note number 6, the profit on the sale of investment relates to the sale of holding ordinary shares in a company quoted on the Lusaka Securities Exchange. So these shares were acquired by Jaden on 1st January 2023 from 84,600 kwacha and sold on 30th June 2023 for 94,920. So this investment was actually acquired in the tax year we are discussing. As such, the profit on this investment is not a trading profit, okay? So it is not a trading profit. This is an investment income. So investment income are not taxed as trading profits. As such, it's not a taxable profit. It's a profit on investment. So we are going to do what? We are going to deduct it from the income statement. We are going to less it from there, all right? Because it's not a taxable income. Then we are told to say, uh, 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 before I go to note 7, just under note there, when you go back there, there's profit on sale of plant. A plant is a non-current asset. It's a fixed asset. So when you dispose a fixed asset, when you dispose a non-current asset, the profit that you make on a disposal of a non-current asset is not trading income. And as such, it must not be assessed when computing trading income tax. All right. So we are going also to deduct it. It's a deductible income. It's not a taxable income. The reason is a current asset is a capital asset. So this income is coming, it's capital in nature. And as such, we must not tax it. It's not trading income. Okay. Bank interest received. Bank interest received is the same as an investment income as well, because you have received some interest from the bank, maybe on a deposit that you made. That income is actually taxed at source, all right? So that income is taxed at source under a different tax system. So we must not account for it when computing business profits. So I thought I should. A loss on a disposal of non-current asset is allowed as an expense. So you disallow it. I mean, sorry, you allow it. A loss on a disposal is an allowable expense. All right. Correction. A loss on a disposal of an asset is not an allowable expense because it's capital in nature. We disallow it. I was right. We disallow it. Sorry for that mix-up. So we are going to disallow it because it's capital in nature. So we add back a loss, but a profit is deductible. All right. Let's go back to note number. Let's go back to note number 7. Note number 7 says Jaden estimates that he has drawn goods from stock costing 3,400 for the use of his family. When a trader who is a sole trader draws goods from the business at cost, we must add back those, or we must disallow those goods at the market value, okay? At the market value of those goods. If these goods have been accounted for have been deducted at the market value, then the profit realized, the profit component of those goods must be added back and taxed under the Income Tax Act. So the goods must be taxed at the market value in this case. So the guidance has been given. So Jaden estimates that his gross profit on turnover is 15%. So the gross profit margin on his turnover is basically 15%. So what that is telling us is that we are going to gross up the costs so that we get the market value. So the 15% component represents a profit that is supposed to make. So we are going to gross it up. We are going to gross it up to find the gross amount or the market value of those goods. Jaden is entitled to a nominal salary of 4,000 per annum. This amount is included in the figure for staff wages. Mrs. Kapotwe worked full-time in the business, all right? So there is a salary for the wife there. So we are told to say she worked full-time in the business. When you give money to your relative, if a relative works in your business, any expenditure made on them is disallowed if it does not make sense to the taxman. Okay, so when you give money to your relative who's working in your business, the payments you give to them must be reasonable. So what is reasonable is not defined by the income tax, but what ZRA uses is they are going to use other workers in the business to determine whether the income that you're giving, either your wife, your son, your nephew, is reasonable. So if we find that your son is a consultant, is a sales consultant, and then another employee who's a sales consultant, they are getting the same salaries, they are getting the same wages, then that would be considered reasonable, and as such, it is going to be an allowable expense. But in an event that your son gets 5,000 and then the other worker gets about 4,500, but they do the same work, they are both consultants, then the 500, then that expense is going to be, the 500 on top is going to be disallowed because that is not a justifiable cost. So in this case, we've been told that the wife is a full-time employee of this business. As such, the wage that is paid to the wife is an allowable expense. Okay, so I think I've explained what each expense, how each expense is going to be treated when we start computing these taxes. So now what we are going to do is, now let's dive into the calculation of these taxes. So let's get to work. Let's get to work. I'm very confident I'm not fast, so you can't come and say, this man was, I didn't get it. I think I've tried to explain. There are a number of things that the income tax but for me, this is free information. I've tried to explain the transactions that are in the question for me to give you the more detailed information in terms of what transactions now you have to come back with some money you need to pay, because that is now information sharing, and that becomes more like consultants, and I'm going to give you a full lecture. A full lecture is available with not detailed notes on this subject, but what I just wanted was to give you a brief. I want you to see the value for the money that I'm actually requesting from. If I say you're a student, you have to pay me 800 kwacha for me to run you through the full syllabus, then you should know that this is the quality of information that you're going to get from me. I don't want to, I'm not that guy who's going to be cheap for information, because information is not cheap, colleagues. So let's get value for our money. When I also need to get value for the time that I'm investing in compiling all this information and in answering questions like this. I need to get value for it, because my value proposition is the content that you're getting from lecture. So yeah, so let's get chatting and let's get to understand these things. All right, so now let's get to work. I would say accountants are very smart people, and they're clean in whatever they do. So we don't like to do things anyhow. All right. So there's a way that you're expected to present information as an accountant. So in this case, you're dealing with tax. So you are a tax consultant. All right. You're a tax expert. All right. You are a tax accountant if you want. So you must present information in a certain way. So this is how you present information as an accountant. So the first thing is you're going to put the name of the business. If you are computing for a business, or if it's an individual, you're going to put the name of an individual. The name that we are dealing with is Jaden Mapalo Kapotwe. All right, and then you go the next line, you say income tax payable, income tax payable for the charge year, tax year, for the charge year, for the charge year, for the charge year, for the charge year ended 31st December 2023. So for the purpose of this question, the tax bands that I'm going to use and the assumptions that I'm using are those that apply to this particular year, which ends in 7 years, in 7 days, for example. Come next year, we're going to be using the income tax bands as announced by the Minister of Finance in October. and the income tax changes that have been made will be employed next year in our discussion. So that is how you present. This is how you have to do your work, and then I can make it bold, and then I'm going to underline it as well. All right, okay, and then I'm going to take out Kwacha there. I'll take out Kwacha there. I'll center that. All right, so I'm going to take out Kwacha there. I can equally make this board. All right. Okay, so the first thing now that I'm going to do, we are going to adjust the net profit that we've been given in the question. All right, so the net profit that we've been given in the question, net profit. All right, or accounting profit, if you may like. Right, undo. All right, so net profit, we're going to add okay, so let me just delete these cells here. I just need to delete these columns. All right, because I know. All right, great stuff. That's what I wanted. Okay, so the net profit, we are going to add that. So net profit in the account is 156,400. All right, so we are going to adjust that. How to do this? All right. Okay, great stuff. $156,400. Now we have to make adjustments. So we have to disallow some expenses. So for one, I can say disallowable expenses. Or now for your sake, I'm going just to put add back or add back. I gave reasons as to why I'm adding back. So yes, so add back. Rent and rates. So rent and rates, we're told that 1/3 of rent and rates relates to the living accommodation. So 1/3 multiplied by what was the amount. So let me do this. Rent and rates. Said 1/3 multiplied by the amount is 6,300. Can I get my calculator? 1 divided by 3 by 6,300. We are saying about 2,100, right? So 2,100. 2,100 there is going to be disallowed, and then we have I can just make that bold. Then we have heat and lighting. So equally, heat and lighting, we were told, and 1/3 of that expense relates to the accommodation of Mr. Kapotwe. So that is also it's also disallowed. Heat and lighting. Heat and lighting. Heat and lighting. All right. All right, so heat and lighting, we are saying 1/3 multiplied by what was the cost? 21,720. So that will give us 1 divided by 3 by 21,720. That will give us about 7,240. All right, 7,240 kwacha. All right. Then we have motor car expenses. So motor car expenses, we've been told that 1/7 relates to private use. So if it relates to private use, the 1/7 has to be disallowed. So we're saying motor car running expenses. So 1/7 relates to private use. Okay. Multiplied by what was the cost is 3,360 was the total cost. So I'm saying 1 divided by 7 multiplied by 3,360. So we are looking at 480 kwacha. So about 480 kwacha. 480 kwacha is going to be disallowed. All right. Then let's go to building extension of the stockroom. All right. So I did highlight that that is a capital expenditure. No negotiations. We are going to disallow it. All right. So you're saying building, whatever, construction works on the stock room. We just going no apportionment here. The whole amount is going to be disallowed, which was 2,200. All right. Then the other thing that we are going to do is increase in general bad debts. So if there's an increase in general bad debts, we are going to disallow that. I did explain the reason. Increase in general bad debts. I gave the reason, so I'm not going to labor on that. So the increase we found in the bad debt account is 2,000 kwacha. And then we have entertaining customers. So entertaining third parties is a disallowable expense. As such, we are going to add it back. Entertaining customers. Okay, so entertaining customer was 900 kwacha. We are gonna add it back. Then the other one is gifts. Christmas gifts. Christmas gifts. That was gin and whiskey. Gin and whiskey is very risky, 50 kwacha. So it was 50 kwacha each, but there was no prominent advertising component on these gifts. So despite them being 50 kwacha each, they do not exceed 100 kwacha, but the fact that it is not bearing any advertising component on it disqualifies it. As such, we are going to disallow it. So gifts was 700 kwacha, disallowed. All right. And then now we are going to look at goods drawn for personal use. So the goods that Jaden drew from the business to be used by his family, we are going to add back or disallow them at the market value. So then this is how you do it. Goods drawn for personal use. Drawn for personal use. We gross it up. So how do you gross up something? 100 divide by, so the margin that is on the good is considered to be at 100%. All right, so it's considered to be at 100%. If they are saying 3,400 is the cost, then we need to find the 15% that will give us the what? The profit on top. So that was a margin that was used there. It's not a markup. We've been given a margin of 15%. So that 15%, we do that, and then we multiply it by 3,400. So 100 divided by 85 gives 1.7 1.176 going there, multiplied by 3,400. So I'm getting 4,000 kwacha. So 4,000 kwacha is the market value of these goods. So the cost is 3,400, and then 600 kwacha is the profit that Jaden makes on these goods. That is the 15% margin. So I'm going to record this at 4,000 kwacha. So I've added them back at market value, right? I've added them at market value. So it's 4,000. All right, let's go. The other one is Jaden's nominal salary. So Mr. Kapotwe is paid a nominal salary of 4,000 kwacha. This is not allowed. It is not an allowable expense because this is a sole trader. Mr. Kapotwe is the owner of the business. So the salary that is paid to him is what we call appropriation of profits. Appropriation of profits are wages paid to the owner of the business, or the profits paid to the owner of the business. So it's a component of his profits. And as such, the Income Tax Act requires that we add back appropriation of profits. All right. So Jaden's nominal salary. It was 4,000 kwacha. Remember, right? Yeah. Then we are going to look at the last item. I think should be depreciation. So depreciation on plant. The depreciation on plant is 4,800. 4,800. Then there's depreciation on motor, motor car. So depreciation is not an allowable expense because it's a non-cash item. All right. So what I'm going to do, it's an accounting policy. Okay. So accounting policies differ from company to company. So depreciation has been replaced by what we call capital allowances in tax. All right. That's a topic on its own. Pay me, you're going to learn it. I'm going to run you through capital allowances, but hopefully this question doesn't have the capital allowances component. So there are other questions that will actually require you to calculate capital allowances. And then after you calculate capital allowances, then put those capital allowances in the final computation of your income tax payable. So there are questions like that. But in this type, so depreciation has been replaced by what we call capital allowances. So capital allowances are standardized. The more standardized, you find they are uniform in whichever company. As long as it relates to certain assets, you get them. So they are uniform. So it's either a farmer. So if you're looking at the assets of the farmers, if it's implements of farming businesses, they all claim capital allowances at 100%, for example. Manufacturing claim at 50%, for example. But depreciation differs. My small business can have my 20% depreciation on a motor vehicle. Another business for my brother can have a 15% depreciation on motor vehicle. Another one can have a 30% depreciation on motor vehicle, same vehicles. So there's no uniformity in depreciation as such. It is considered as a capital expenditure. Sorry, it is a non-cash item as such. We must add it back. All right. Even I think for those that do finance, when you are trying to determine how much a customer makes from their operating profits, you do have some adjustments to do when arriving at what we call EBITDA. So yeah, it's the same. Depreciation added back to the operating profits, for example. Yes, so I think I've tackled most of the expenses that we've been given in the question. So as I said, accountants are very smart people in the way they report things. So we are going to say sum. I'm gonna sum these now to get the total of the expense we're adding back. All right, and then I'm going to put there, and then I'm going to do this, that minus this, that plus that. All right. So we have added back those items. So this figure is taxable. So you can see that the accounting profits were reduced by 29,620 on items that are taxable. So that is the conflict that is there. So now we need to add these items back to the net profit so as to arrive at the adjusted business profit. Now, this is not the profit that we are going to hammer tax on. Okay, we've got some incomes that have been charged to the accounts that are not taxable incomes. So those incomes must be deducted. We need to deduct them from the accounts, and then we hammer the tax rates on that income. All right, so let's go. All right. So now what I'm going to do is I'm going to say less deductible. Less deductible income. Deductible income. All right, so I'm gonna less deductible income there. So the first income that I have is profit on disposal of plant. Plant is a non-current asset. As such, the profit on disposal of plant, I'm gonna take it off. That was 2,400. Then the other income there is profit on investment. That was how much? 10,320. I did explain the reasons for these, colleagues. I'm not going to belabor the point. Then lastly is bank interest. Bank interest received. In the question, if you can go to the question, you'll find that there's loan interest, all right? There's term loan interest there in the question. Now I need to clarify something here. Interest paid on short-term finance, for example, overdrafts. The interest that a customer pays on short-term finance on overdrafts, that interest is allowed for tax purposes, all right? So it is an allowable expense. But if interest is charged on a term facility that was used on a term loan that was used to acquire a non-current asset, for example, that is a disallowable expense because it is a capital in nature. So the nature of that transaction is capital. As such, the interest that is charged on a capital transaction is not an allowable expense. As such, are going to add it back to deduct it. All right. So that is something that I thought I should just echo. So if it's a loan and it's short term in nature, that interest is allowed. All right. Apologies for that. All right. So we've got the bank interest received. So bank interest received is income that has been taxed at source. For persons, I think it is taxed at 0%. So when you receive that income, it is already taxed under the withholding tax system. So you must not tax it again because it will be double taxation. So you need to net it off from there. So we are told to say it is 540. All right. So as I said, accountants again are very clean in the way they present information so that people are able to follow. We don't just do things anyhow. So as such, we do that. Okay. All right. So now what we are going to do is we are lessing this. All right. We are going to say this now minus this to arrive at the sum. All right. So now here, this is now what we call business adjusted. Business adjusted profits. Business adjusted profits. So this is where now we are going to charge our tax. Okay, so that is the profit where we have to charge tax and not the 156,400. So the 156,400 was an accounting profit. Now this is the taxable profit. Okay, so this is a profit where we must hammer our tax on. All right, so for me personally, I don't like remember the tax band. There's a component that is a 0. All right, so I don't like reducing it there before I could arrive at the taxable profit. What I know is that 4,800 kwacha that you are given, for example, in 2023, is actually a taxable. It's taxed at, it's just that it's taxed at 0%. So for me, as a trained accountant, I don't say that is tax-free income because it's taxed at 0%. Okay, I don't say it's tax-free because it's taxed at 0%. So you tax at 0%. So I'm not going to consider it as exempt income. No, it's not exempt. It's taxed at 0%. That's my opinion. So we might differ in your opinion. But yes, that's my opinion. It's taxed at 0%. So I don't want to say less exempt income. There's no tax exempt income there. All right. So I'm not going to say less tax exempt income. So I'm going to tax it at 0%. So now this is how I do it. Now tax computation. So income tax computation. I did this and I passed. I passed my tax courses. All right. So you should not worry about my approach. I passed my tax courses using this approach. All right, so now let's get to work. So we are saying tax computations now. We are saying the first should be, how much is that? 4,800 times should be the first 57,600. The first 57,600 is taxed at the first 7,600 is taxed at 0%. All right. Then the next 24,000 is taxed at 20%. Then the third or the next 25,200. 25,200. The next 25,200 is taxed at 30%. Then the balance is taxed. The balance is taxed at 37.5%. This is the pay system. So why are we using a pay system? This is a sole trader. All right. So this is not an incorporated business. This is not a cooperated, this business is not incorporated. It's not a registered business as per Company Act. This is a business registered as per Business Act. All right, so it's not incorporated. So if a business is not incorporated, you are going to tax it using the pay-as-you-earn system, the same way you're going to tax an employee. All right, so this is what we're going to use. So in the charge year 2023, those are the bands that we've been given, and those are the tax rates that are applicable. But I know starting next year, the last band has been reduced by 0.5%, so it will be at, the last band will be taxed at 37%. All right, so those are the income tax bands that we are given. So tax paid there is 0. So what I would do is 57,600 multiplied by 0. By 0 by 0%. It is 0. All right. So no tax is paid there, 0. Then the next 24, we are saying 24,000 multiplied by 20%. 20%, we are paying 4,800 there. Then the next 25,200 multiplied by 30%. It's that. Then balance. So now how do we get the balance? It's easy. So just get this figure. Sorry, just get this figure there. The one where I've put the cursor. So just 172. All right. 172,760 minus the first 57,600. The first is tax-free. So you are remaining with about 115,160. Then that 115,160 again minus the second 24,000. You are remaining with 91,160. That 91,160 minus the third 25,200. What you remain with now, the balance that is remaining is 65,960. 65,960. That is your balance, and this balance now is going to be taxed at 37.5 cents. Okay, I'll repeat how you get those things so that you are aligned to my way of doing things. All right, so what I said was get the business adjusted profits, remove the income that is taxed at 0. So what I said was 172,760, remove the income that is taxed at 0, which is 57,600. You are remaining with 115,160. Then remove the second 24,000, though the next 24,000 from what you are remaining with, which is 24,000. You are going to remain with 91,160. From the 91,160, remove the third 25,200. What you remain with is the balance that must be taxed at the largest tax band, which is 37.5. Right? So 37.5 is equal to 65,960 multiplied by 37.5%. So on the last band, on the last income is paying 24,000. And then now what you do is tax payable by Jaden Kapotwe is a summation of this sum. All right, so we are saying the income tax payable, income tax payable, income tax payable by Jaden is this. We can make this a bold figure. This one and this one should not be in bold. All right, so that is how an accountant must print this information. Then when you're using Excel, as accountants, they want us to leave those zeros hanging. So let's knock them out. All right, let's knock out the zeros. Let's not be hanging. It's professional. Okay. All right, let's knock them out. All right. And I like this font. I like this font. The font I like is this one. Yeah, so I like. All right, so colleagues, that is how you compute your income tax payable by an individual or income tax paid by an incorporated business. So some of the rules that I shared with you are very pertinent when you start talking about company taxation, we start talking about partnership taxation. Those things are very pertinent, and we're also going to look at the rules pertaining to now employees, those that are in employment. What are the rules that guides their the business expenses? So this is how you calculate your taxes. And if you are interested, when I've delivered this question and you'd want me to provide tutorial services for you that are sitting for your CA 2.4 in CA 2.4 in March next year, and those that are sitting for CA 3.4 in March next year, get in touch with me. Get in touch with me on my number 0977 136255. Yes, and I'm going to be available. Share news. I'm going to post this video on both YouTube and Facebook. You can still engage me from there, and we are going to hammer this together. Thank you very much and have a blessed day.